Oh, my friends, Patreon and YouTubers. So, this video, I've done a couple recently that I haven't posted. This one I felt like I really needed to get out. I've alluded to it in some of Patreon chats and in the tier chats, but I want to point out and then use a lot of supporting evidence. I'm going to show you charts on oil. I'm going to show you charts on gold, charts on silver, charts on the US dollar, charts on the SPY, and happen to do an individual miner analysis chart. And I'm going to put this on YouTube and I'm going to put this on my Patreon. So a lot of you in the Patreons know what I've been saying, but I want to share this with the general public. And I want to help people understand how to play potentially this next 3 to 6 weeks and not make mistakes. Nobody's perfect. We all do. And sort of paint the picture of where I see the markets going, sectors within the market. I'm not really going to give away any stocks. I will analyze the stock. But having said that, a lot of people know about this stock, and other than that, it's sort of a teaser for YouTube to see the value behind what all you Patreons receive regularly. All right, so let's dive in. So this is something that B of A did some research, Bloomberg did some research, and basically it points to what happens in war events over time. I mean, I could go back to World War I, World War II, but I felt like analyzing the wars really over the last 6, 8 events and conflicts. We call them wars sometimes, but they're not really the type of war that World War I or World War II was. And part of that has to do with just the technology that you fight a war. I don't believe that troops will be needed in in Iran, but I do think it'll take longer than people thought. And most of that's due to the terrain, I think, in Iran and the fact that it's so close to that narrow Hormuz Strait that impacts 20 to arguably 25% of the world's oil supply. So let's dig into this data, and then I'll tell you what I draw from the data and why this time is slightly different than maybe an average, and why it's close in some cases to the averages or the medians. Remember, median's not a perfect average, it's half the items above and half below, kind of like a middle point, whereas an average is just a pure mathematical add them all up and divide them by the numbers. So it can vary greatly in math, right? Whether you use a median or whether you use an average. I played around with both. I thought for I get better results that fit the narrative, although they're not radically different with the median data. So let's have a shot at that. For you math guys, you'll get what I'm really talking about. For non-math people, let's just go with it. You're going to be tired of looking at charts and data and everything by the time I'm done, but you're going to see that it's very practical and logical what I'm saying. Now, whether it bears out, I'm not a soothsayer. I can't predict the future, but I have a lot of people that I study from that are cycle people, and they paint a scenario consistently across 2 or 3 different, completely different type of cycle people, as well as somebody that looks at the lunar and the moon and the impact of that on cycles and how that's worked in the past. Gets a little esoteric, but hey, there's some value to that. Um, Otherwise, there wouldn't be things like the myth behind the Chinese New Year's and astrology. There's something to be said for it, but you understand what it can do and what it can't do. And the same thing goes for 17 or 18 technical indicators, anywhere from Elliott wave to, geez, you name it. I could rattle off 18 names, but I'll just leave it at technical analysis. I tend to look and use, MACD, RSI, moving averages, and then I like Elliott wave. Again, not it helps you understand the size of the movement, but Elliott waves can get invalidated and you're thinking it's going to do something. So I also will introduce you to one of my newest technical indicators. And I have it from some psycho people that I learned it, and it's a slingshot effect. We'll talk about that in a little while. Kind of like a bow and arrow and a slingshot. We'll get into that. So looking back to 73, and you notice there's some Iran impact here. Israel is involved. You've got Gulf Wars. You got the 9/11 attack. You've got the Iraq War. You got Russia, Ukraine more recently, real recently, in the last 3 years. And then you have a Israel Hamas war. And I could add, and I probably will in another month, the current US Israel Iran war. But I can draw some conclusions on what we might expect. Okay. And if you're like me, I've been glued to just watching all these different people analyze it. But I only care about it from the standpoint of its economic impact, oil. So this data should be really useful. So looking back at Yom Kippur and that particular 73 event war, you had and all this is all set up to look at the US stock market, right? So I'm US stock market centric, treasuries, interest rates, bonds, right? Gold, oil, and copper. Now, I'm going to analyze silver for you, but I'll just tell you, so goes gold, so goes silver. Silver can be a late runner, but if gold is going to go up for 3 months, silver is not going to crash, right? It may go up less than silver or less than gold and then go up a lot more than gold. But they're very much tied in their fear trade and in their proxy to gold being a precious metal. There's a whole separate effect on silver of being an industrial commodity. And that is true of copper and platinum and palladium. So I drew what data was easily pulled out by Bloomberg and B of A. So that's what you're looking at. So, but I massaged it sort of in my own way. So it's different than what the raw form was. But I will give credit to credit source that it's an extract of Bloomberg and B of A's analysis. And then, as I said, I plan on adding to it. So what do you see? You see 3 month, and this is arbitrarily picked by them. I will say to you that I think we're going to differ slightly in my analysis of what I'm going to look at for these things. I'm going to look at a 6 week, and then 6 months is fine. And that kind of times exactly with what I see the impact on gold and silver. I think we have 6 weeks of downtime. That's been my cycle work. And then when I look at it here, it maps this kind of a scenario. So you have, in the Yom Kippur War, you had an immediate drawdown in the stock market. That's only happened 3 out of these last 8 skirmishes, wars, if you want to call them that. Okay. So we went down the most in Yom Kippur. We went down not only for 3 months and also 6 months. And remember, any war can come. We're in a cycle. We are right now, in my view, just finishing when I show you the S&P, a 15, 16-year bull market that is topping. So we're about to go through an ABC, a WXY, an ABCDE. We're going through a retracement wave in the stock market. So that fits with my scenario. That can be 6 months, that can be 12 months of the stock market's not the roaring stock market that it's been over the last 16 years. Now, I'm not predicting a 1929 crash, but I'll show you a chart on all the possible outcomes for the SPY, including what a 29 crash would look like. Okay? So you're gonna get a lot. And hopefully I made some notes so I don't get lost and confused and skip things like I do when I just go from, because I spent a lot of time building all the data. I hate not showing it all. So that's a pretty ugly scenario for a stock market. It didn't even vary much from the initial reaction to the war to 6 months later. And then what happened to Treasury? Well, they went down 2% and 4%, a muted move. This isn't saying it's 2% interest. It's just saying you had a 2% decline in the treasury. Now look at gold's impact back then, but also where were we in 1973? Well, we were in the middle of one of the most bull markets in gold in history, the 1970 to 1980. The 74 to 76, we pulled back 50% in gold, right? Gold went to 200 and pulled back to 100. That may seem like small potatoes, but it's still a 50% move. How would you like it if we're at 5,000 gold and went to 2,500? What's a whole different scenario where we're at? I don't expect that. I do later. We may get a 40% pullback in gold, but probably from 9,000 or 10,000 or 11,000. And then I still see us going to 13 to 15,000 in gold. So, there's certain things that rhyme and they have rhythm with past decades. And again, the 70s fits that scenario. So you went up 20% in gold in the first 3 months. Now, gold can be a fear factor and move up, but it almost always performs better in the subsequent 6 months. The exception being was down some, then down 3%, down 4.5, and down there. But what I would say is, where were we in a commodity super cycle, right? So you got to map several things there to see the explosive or non-explosive impact, right, on whether we get a slingshot move. So you're looking, and I'll move away from here so you guys can see it. This should be red also. -6. So in your treasuries, I'm not going to go into them too much. You can look at the data. Stock market fits the cycle where the median is 3.2 and 3.3. So not a big swing in the war. Even here, these matched. These matched. This one didn't. We got a bump, but I imagine that's more to do with the stock market than the Iranian hostage crisis. Now, go over and look at oil. You want to talk about that? That was an oil. I mean, I lived that. I was in the lines, right? Lining up in my car. I was in my mid to late 20s at that time. So I know well about it. Late 20s actually. And I remember it like yesterday in some ways. So you had oil was impacted 44.5 and 55.6. Really hit, right, to where we had shortages of oil because the US at that time was importing so much oil. We didn't have the Permian Basin doing what it's doing. We didn't have the kind of additional drilling techniques. We weren't really producing that much. We were foreign dependent, which thank God it kind of kicked us in the butt and changed some of that over presidencies and administrations into the 80s and 90s. So gold was impacted massively, but look where you were in that commodity super cycle, right? It went 20 and 75 and went 81 and 37 because all the way up to January of 80, gold and silver flew, right? That was the decade that metals moved. We certainly had another movement in the 2000 era, the 2001 to 2011. We only had two conflicts within that time frame. So this was muted 7 and 11% in the Iraq war, but that's still up, and a -5 here. Gold hadn't really woken up. I was starting to trade stocks and do things with oil in early 2001. Yeah, it was moving a little bit, but I mean, think about, you know what gold's price was? 250, 280, $300. Not worth, wasn't worth a lot, but it went on by 2011 and 1920 something. That's a big movement to having started 250, right? It was a massive swing up in gold. And the 70s outdid that, right? You're talking about $25, $35 gold running to 800, $850 at that peak in 1980, with the Hunt brothers trying to squeeze silver. All right, so look at the data. I think it's valuable. So, what do I draw some of the summaries with this? I want you to think about this. So, here's my yellow context. So, with oil at $100, as it flew to, it went to 117, 120. I don't remember the exact peak. I'll show it on my oil chart intraday, just, not that long ago. Goldman Sachs says 2 days ago that inflation at $100 oil will stick at 3%. That's much more than the Fed would like it to be at. So is the Fed going to run out now that we ran to 99 on Friday the 13th? No, because the Fed can't raise rates simply because of the debt level and inflation. But that would be the thing to fix inflation. That's what Volcker had to do in the 70s to get double digit inflation. In other words, in the treasuries, you could go get 14, 15, and 16. Mortgage rates went to 14, 15, 16, 18. As I mentioned a few times, I bought a second real estate investment in 1980, and I had to get a buy down mortgage. The builder built the house, and mortgage rates were around 13%. And so I got a buy down to 11 and a quarter, I think, for fixed for 5 years. There's no way I wanted a variable at that time. Knowing longer term they may come down, but they could have gone even higher. So Volcker, the Treasury Secretary, aggressively attacked that. And he got rates down in time. So they really are in a different situation. So oil should stay quite firm since this conflict is in Hormuz. If this conflict involves a Gulf country, but there's not that narrow passageway, or they're not the only producer, right? So the Iraq situation, look at the Iraq war. We had a minus 1.8 and a minus 4% in oil 3 months and 6 months into that conflict. So not a big impact, right? But if you had to measure this, we're looking like these numbers, right? We've gone from $60 oil to $100 oil, right? It's bigger than these numbers. Now, I suspect it will grow larger in this 3 month realm than it does in the 6 month. So I do think oil will come down. But to me, I don't see it being below 80, even if the war is sort of over, or the threat of Hormuz is not, nobody's going to mine it, nobody's going to stop it, and the ships are flowing again. So I think the days of $60 oil are over. It might temporarily spike down below, regress down below 70, touch 60, but I think the days of 80 oil are here. Now, when you see my target on the oil chart, that's a whole new thing. I've been telling my Patreons, they know this. I don't know if I said it on YouTube. My target was 140 and 240 for oil. My target now in the commodity super cycle, just being shown what can happen here, even though I was counting on some of this, is 400 plus on oil by the end of the decade. So put that in your pipe and smoke it, as my grandfather would say. Prince Edward in the can. That should some of you that are much, much older, like I am, may remember that. I get a kick out of it because we thought we were all really cool as, 7 and 8-year-olds. We'd grab that phone. Phone was a whole different instrument than it is today, right? Your landline. And we get on there and we just dial a random number, or dial a liquor store or something. Do you have Prince Edward in a can? Oh, yes, sir, we do. Or, yes, we do. Well, could you please let him out? So a little humor for you guys, a little old silly humor, guys. Takes the edge off all the seriousness of this because this is some serious, impactful economic wealth generation, targeted wealth generation. Okay, so there's a lot of things that you can draw, and I think that we draw back to these times a little more here with the oil. Although I don't think this outcome is there. I don't think we go up 43 and 124. But part of that goes back to how long does a conflict? If in 6 months from now ships aren't flowing freely through Hormuz, then that's a different scenario. That easily could be the case. We could beat both those numbers. We could have 70, 80 here, and we could have 200 here. At 60, could go to 180. So a tripling is 200%. So, guys, this is nothing to sneeze at. Now, and we'll talk about it. So, what about gold? Well, I'm going to give you my scenario. So, I'm not going to continue to talk on this. Um, but typically, the average, this median, what happens? You get a conflict, and the conflict oil spikes. It's temporary and it goes back down. I don't think we're in that scenario. But I don't think we're necessarily in this scenario. I think we get a spike and it pulls back. But that spike is already, let's see what it is at 3 months, but it might be a 60 going back to 40%, something like that. 80% going back to 40%. The days of cheap oil are over. All right, guys, let's move to, and so what else can I say? So when oil goes up initially, what can you expect? Stocks drop, gold drops, because it's a shock, right? It's an inflationary, it's an economic, it's socioeconomic, it's a shock. So then later, gold will go up because rates likely get dropped and gold spikes even higher. So my cycle guy and a couple of others. And when I see that in a lunar person, when I start seeing 2, 3, 4 type forecasters talking about things that are likely, again, nobody goes out and says this absolutely is going to happen. You start to see a pattern. And when I see a pattern, even in my commodity super cycles a pattern, guys. I've studied them. I understand them. So what was I saying 90 days ago to 120 days ago to my Patreon? I was saying, hey, gold moves first. It's the fear trade and socioeconomic debt. And gold isn't going up. The dollar and the fiat currencies are going down. Happens in every commodity super cycle. It happens more aggressively in every commodity super cycle. It's where we've run out of the budgets. We've ignored fiscal responsibility to where it hits us. And every 15, 20, 25 years, you get slapped in the face and say, that credit card debt, that's no good anymore. We don't trust you to pay it back. We think it's gotten crazy. Your credit is no longer. You don't have an 800 credit score. You don't have a 700 credit score. You've got a 450 credit score. And I'm not going to loan you that much money. I don't care if you're the world's reserve currency. And then the US, as being the power in the world's reserve currency, says to Russia and other countries when they don't like things, you know what? All those treasuries you own, we've got all that money. We got sanctions on you. Good luck getting your money back. We're freezing your account. Now, luckily, Russia's bought a lot of gold. They had no consequence but to buy gold. And the gold has gone up more than the paper money they had has gone down. So they're ahead of the game in that scenario. That was not the US's intent to put sanctions on Russia. But in the end of the day, these kind of things happen. You've got currencies, you got stores of wealth, you got stock market at a 15, almost 16-year high that it can't sustain those levels. And so the fear and the uncertainty and the war and oil hits us in many, many ways. It surges inflation. Take a trip on an airline, go on a cruise ship. They use diesel, but it's an extraction or high octane, use different kinds of fuels, but it's all fueled out of, no pun intended, out of oil. And that's the nature of the beast. So it's not a positive thing. Gold can certainly sustain that. Gold's got such great margins now that I'm going to show you where I think gold's going to get whacked in the next 6 weeks. I think in 3 months, we're ahead of the game. I don't think the whacking lasts that long. I think by the end of April, we've already started back up, but I will talk to you about it could get ugly again. So I'm not bullish on my minor short term, but I won't give a lot of strategies here. I say that for my Patreons, but just be aware that I do see it going down. All right. So we'll get into that. Let's see. Which chart do I want to start with? How about I start with oil? Hopefully I don't mess these up. I always have a hard time moving. And I like to paste them, but when I paste them, I can't go back and show you other things when I put them into Google Sheets and they're fixed. These are live. I built them. I can change them. I can change the time frame. So, where do I see oil going? And what's the natural order of setup? Well, I start with something called Elliott wave that gives me some predictive, and I removed a lot of the percentages, but I've placed these lines right at those levels. So going back, we're talking about 2008 was really, in my opinion, the first level up to a one wave. And then in 2020, we had a two wave. Now, three can go on out to the 30s, but I'm just showing it here in the space. Okay. So it's very possible, probable that we had a wave one and we hit that in 2022, last time oil spiked. And we've been pulling back, right? We got into what? The low 50s. And a lot of people were saying we're going to 40. And I started talking about people in this time frame in December and recommending oil plays. Chevron, Exxon. I'm not going to give you some other names, that's for my Patreon, but some other oil plays that have done very, very well, even though Exxon and Chevron, anybody can go out in the stock market and say, who are some of the biggest oil companies? But I have some other ones that have done really well and pay 3 or 4 times the annual distribution of the other oil companies, and I think also have massive upside. So I'm very bullish. But on the oil ecosphere, I got to tell you guys, it's 20 times the size of the precious metals. Just in the precious metals, I have a database of 800, and I think it's somewhere between 870 and 890. Once in a while, I find a duplicate. I found somebody got bought out. I'm always, so it's pretty large. If I had one for the oil ecosphere, for all the midstream, upstream, and downstream players, oh my God, it would be 10,000 maybe. But I do research and do a lot there. And my Patreons find companies and ETFs and players that are fabulous that run. You need income? I help with that. I got some great income ETFs that I recommend. So those are the things I do for Patreon. But forgetting exactly the time frame, my target for oil is 400 plus, as I mentioned, right? This next wave three, whenever it happens, I imagine it's up 280 or so. Then we're going to retrace our, 0.382 to zero point 0.5 of the move from the bottom of 2 to the top of 3. That's your normal Elliott wave for a retrace, a 0.382 to a point 0.5. And then in 5, we're going to go high. And that's usually 1.618 from the low, but it can extend. It can extend to 2.618 times. Elliott wave allows for a lot of things. It's not perfect though. It's not going to tell you absolutely. If it was an absolute future teller, there couldn't be a stock market because everybody would be super rich, right? There would be no guessing, right? So this is exciting to me. I don't look at it negatively on my miners. I say, hey, if I'm a silver miner and the world needs silver on its economic side, right, on its industrial use, then if oil gets too high and it costs too much money, a silver producer is going to say, hey, at $120 silver, no thanks. My cost used to be $30 to mine it. I sold it at 40 and I could live with that. But now it's 120, but fuel is so high, fuel's 200 and something a barrel, then I'm not going to mine it. So the price has to rise. So you've got a lot of impacts when you get into commodities. All right, let's look at the next thing. This will hit home to you precious metal people, and this involves gold. So I took this scenario to do a teaching here. So I can go back and look at this. This was basically the big, massive consolidation. What we had back over in 2024, all the way back, was gold going from in 2024, 2000 to where it got to like 4,000. And everybody's like, well, here, what was it actually? So it was 3,500 in April, right? This little move up into May. And all of this triangular consolidation, all was between 3,300, 3,500. And then finally, this is physical gold, but what this final launch up to 4,400 in end October before we got that first, 20% pullback in gold and the miners, was the pure breakout, the next level of breakout for gold. And that finally got the miners just running like crazy. Some of them have been moving up in all of 2025. And ironically, that's when I started my Patreon. So the people that got in early, and even some of you that didn't join Patreon, but listen to my YouTube channel back then, I was giving away some of the names and some of the indexes and some of the ETFs to buy. Not like what I do now, but I did it at a level that if you'd have just bought those, you would have been up like 180% over the next 6 months. And that's what a lot of my Patreons did. Okay. And then if you use options, you did other things, you can leverage on top of that. So we all know then what happens after that with gold. So gold corrects. And actually, I thought this was an A down, a B wave. I thought the C would come down to about this level. It didn't. It's what I call a halfway point. This was a run from here to here, and the distance or the gain was round halfway. And it was a triangular formation. This appears to be different, a little longer, because now we ran, to 56.26, right? You have to, anyway, don't worry about the line, but 56.26 is where the number was. Okay. And I draw this parallel channel here for you to be able to see. And then we came down in a big A wave. We hit 4,400 gold, bounced hard, came back up on its B, and we're very likely, this is my scenario, gonna meander down. And what's fantastic support? The same 4,400. So I've got a somewhere 43, 44. Could it go to 42? And what I did, this is a 200-day support line. I should have made it a different color. But this is your 200-day moving average. Okay. and it's around 39.69 right now. Well, I can extend it out on the same structure. Okay. And I have us by the end of April or May, when I think we finish going down, hitting the 200-day moving average. Now, if we're below it or a little bit above it, maybe we go slightly lower. So I would give gold 3,900 to 4,400 is my absolute low range on this sell off. And why is the sell off happening? I'm going to show you the DXY, the US dollar chart. They're typically opposite. That when the US dollar runs, gold goes down, stock market goes down. Well, I see both those scenarios with the war. I see the stock market having hit a wave 5 high and ready to retrace, is retracing, and I'll show that chart. Gold and silver, they're simply correcting. They're having a rest period. So that's why I think we could go here. We may only go there. I think this is adequate time frame to late April. And it may not follow this exactly. It may bounce up here, it may do this, but I think this range is where we go. And I love this because this gives what I talk about the slingshot effect setup. What does that mean? So you want to shoot a bird, you want to shoot a can, hopefully you want to shoot a person. But on your slingshot, what do? You pull it back, right? And if you got a really good, almost professional slingshot, you know, it's going to be hard. And the harder you pull it, the further you pull it back and are able to, the more it accelerates up. Well, you could say, well, Bruce, why do you bring up in the stock market? Because the stock market and a bull market likes to buck people off. It wants the fewest people. The smart money and the manipulators, they want to allow it to go down so that most people sell and they want to pick their pockets. They can get a little bit cheaper. If I get people scared here, right, then more people sell. They put stop orders and they watch where the institutions watch where the stop orders are. And the banksters are always been, guilty of this. They play games and they reach a point where they're now all long and the insider and the smart money is all long around these levels. They don't have to get in at the bottom and off she goes. You're like, who the hell's buying that? Well, the smart people are buying it. I'm buying it. My Patreons are buying it because we know where we're going. Because we're nowhere near a top, and the miners are going to accelerate much greater than the metal is because they've got leverage and they're still very undervalued. But will the miners go down when gold goes down? You bet they will. So now I did a scenario because I'm really saying by cycle work, May to September. I think by the end of September, we should be a minimum 6,600. Heck, B of A, JP Morgan, other people, Goldman Sachs, they're all saying 63 and 6,600 gold. I think that's a conservative number. My cycle guy I trust the most is saying if we get to 7,000, that's showing the extreme. Well, look at my parallel channel, guys. Where's that? Look at it. In July, my parallel channel, when is it? There we go. August 4th, my parallel channel is showing if it's at the top of the parallel channel, it dropped below here, gets back in the channel and gets up in the upper half, it gets to 7,000. Well, guys, once it's above 7,000, we're going to 8 or 8,800. And when you think about percentages, it's not that big a run. 8,800 is 38% of 56, right? I mean, the distance between, let's say 8,000. Let's do a simple one. Let's say gold's going to go to 8,000. Well, from 56, that's 24. That's 30 something percent. So that's a 30% rise from where it had already been. Well, gold went up all of last year 50%. We could have another 45% year in gold, right? So if you take, I'm just doing this spontaneous, take 4,400, it's the start of the year, okay? 4,400 and add 50%. That's 6,600. That's the conservative. So if we matched last year, we're going to go and we could easily beat that. We're in that rip period. So let's see, maybe it's only 66. But guys, 66 from down here again, we've come back. The slingshot effect with the miners getting re-rated, even our second quarter for gold, our first quarter, which we're going to report in late April, and then even our second quarter at these numbers, it was only 4,100 that the best miners sold gold for. So the miners shouldn't even be down at all. And when they go down here, they're going to be way down. So that's the scenario, guys. Let's go look. I've got silver in the S&P. Let's do the dollar. This one I find, because I love chart analysis and technicals, not only Elliott wave, but this is fascinating. I was able to pick up on two patterns here, a pattern within a pattern, right? So I got two for the price of one. How about that? So we're looking really just over, this is 2026, so we're looking around March on the dollar. So think of, even though there are periods of time where the dollar and the stock market and gold all move together, typically it's rare, right? You may find a scenario for 30 or 60 days they move together, but typically they're opposites. Gold and the stock market like for the dollar to get weak. A weak dollar is good for the stock market and for gold. Rate cuts are great for gold when you're going from high interest rates and you're cutting to go to lower rates. But things, not everything holds true at all times. So on the dollar, this is a US dollar, the Dixie as it's referred to as, right? So if you go back, this thing has been much higher. It's been 120 over time. I don't know how far I'd have to go back, probably quite a ways. But you see here, look at 2025. That was the start, but gold was around 3,000 or something. 2,500. I don't remember the gold price at that time. But look at where the dollar ripped, right? So that certainly had an impact on gold. And then you come down here. Well, what I did talk about was this area. I talked about August until December, well, October we had a correction, but this period was a US dollar going down. And what did gold and silver do? They ripped. I mean, really ripped. And it only went from 100 down to 96. And gold and silver ripped. Silver really started ripping in here, even when the dollar was up November, December, January. So they didn't care that much of what it did. So we're now back up and the dollar's kind of broken out. I drew this yellow line all the way over here back to June. So we've seen one, two, three, four touches. Now we're breaking out. My guess is we run up here, we come back, we move along here, and we probably fail and break down. But we probably don't do that till May, right? And so it may even stay at this line for a little longer and gold just says, I'm moving anyhow. And then when gold really gets its momentum is on the next sell off. I really don't think, I would think this is probably a maximum run you'll get 103. I don't see anything higher in the dollar. Inflation will hurt. Okay. So that, and then what the patterns, this is a triangle or a wedge. So when you get in a scenario like this wedge, you reach the end of the wedge, you got to go one way or the other. And typically, if you break down, you're going to go to the bottom of the wedge. If you break out, you're going to go at the top of where the wedge started at a minimum. So there are just rules and laws for head and shoulders. Many of you know that where the head's at the top and the two shoulders down below. And that's a bearish count with a neckline. Well, when you have an inverted, is what they call it, an inverted head and shoulder, you draw a straight line across the two shoulders when they're the same heights, and you measure from there to there, and that projects up, which is just about here. And so what did it do? You got a pole pattern, a run up, two big candles, right? And I'm on a daily. And then I start consolidating. If I had volume on here, the volume probably slows down and the jump up was on big volume. And then it's going to go. That's a bull flag pattern. And there it breaks out. So we need to watch the dollar, but I'm already predicting it moves up some more because I see gold going down, silver going down, and the stock market going down. Well, speaking of the stock market, let's go take a look. All right, guys, I've been pulling this off pretty good. Knock on wood that I didn't make a bunch of errors I've been making with moving my charts around. All right. So, again, this one goes way, way back, but that's not of consequence, right? So basically, the wave count started around 2000. We have 15, or sorry, 2010, 9, 10. We're 15 years in, 16 years arguably into this bull market, a rather long one. And have seen us hit the fifth wave top, 5 of 5. I don't see any more extensions. I think we're there. And that's, right around 7,000, right? 702 or something. And what have we done? It just kind of rolled. You know what they call this? A rounding top. Those of you that want to learn more about technical analysis, go out and ask AI or even Google, give me an example chart of a rolling top. They almost always roll over. And since we're at 5 of 5, we're going to get a retrace. We're going to get an ABC, ABCDE. There's various scenarios that it forms. Hard to know that. But here's some best guesses on what the first wave down would be. Almost the best case scenarios is 0.382. So here we are off the top, right, of 7,000, 7,001. We closed on Friday at 662. Is it 672? Let me put it right on that. 662. Okay. So the first retrace after a full 5 wave impulse is usually standard is a point 0.5. So somewhere between point 0.5 and 0.618. Well, that's pretty ugly, guys. I mean, that's talking about an S&P from 700. Let's say it's at the point 0.5, 371. So it's going to come back to 371 on the S&P, the ETF trust, right? So let's see what the shape of that looks like. You could get an A wave down to that level, a B wave up, and a match pair C wave. You could get a shorter a B retrace, and then a C that came down to 50. What's the likely lowest case? Well, guys, all my cycle work says we're not entering a 29 type situation, that we have too many tools and that. So could it? Certainly. Look where that is. You don't want to live through this. You really don't. That's just plain ugly. 184. That's 0.786 to reach that level on the S&P. That's a 29 crash equivalent. And you do not want that, nor am I predicting that. Some people are. A deflationary bust. I think we got too many tools. I think they'll print money like crazy. The money will last longer, but that's why I think we're in these kind of scenarios. So guys, be careful out there. That's why I talk up to my commodity super cycle. It's why in my Patreon we have an options tier. I'm adding a swing trade tier to that. Okay. And then a lot of this stuff is buy and hold, guys. Sometimes we do leveraged plays, right? How do you protect? How do you hedge your gold and silver? I talk about that. My Patreons know. And sometimes I say, hey, this is simply a retrace. I've got a certain amount of positions I'm not going to hedge. I've got some that I'm going to hedge and I'm going to load up on cash and I'm going to buy like crazy at those target lows, which is exactly what I'll be doing in the April timeframe, maybe even March. And I have my target levels that I tell on silver and gold to be looking for to load up and on the miners. I'm not addressing the miners here because I want to protect my Patreons. Okay. But please be aware of that. When I make this video, I'm going to have an intro and my intro is going to have my Patreon info in there. I think you'll like the intro. It's a cooler, nicer looking intro. I've been playing around with it. I'm going to stick with the logo I've got in this one, and this is the one I'm going to use going forward. So just be aware of that. I've been testing and playing around with stuff, but I think I'm where I want to be. Okay, so look at these scenarios. Either way, we go down. Now, I don't think it's a 4-day straight down candles. You see that sometimes. I think it's just I think it gathers momentum, right? It's coming up, it's topping, it's going down. It could get aggressive, right? I mean, it's going to be on this kind of a chart. It's probably going to be over here. So you're going to be at this level this soon. So, it's a lot of little movements. There'll be some big stuff. All right, what's left? Let's talk about silver. Love, love, love silver. Silver was the champion in 2025, people. You bought physical silver, and I bought AGQ, a 2x silver, a leverage silver. You were up big, and I mean big. So here's my plan. I could get rid of this stuff. But basically, I see us in silver in a wave three. And we got there at the end of January. And then, guys, we had a 41% or percent retrace here, around 64. I've moved this chart and squeezed it a few times. The green line gets you there, 63, 64. That's where this went in the A wave down. And we've meandered in this B wave up. We did an A, B, C, and very likely we go back. My best guess now for this late April is we go back 63, 64 silver. We see the first level of support on this A wave. We came in here and we hit like 72. Then we went into after hours and silver sold off. It sold off quickly down to 63.90 and then it bounced and it hasn't been back there since. So I think that is still a target, but we're closed at 80. So we got a ways to go in March and April. And so I'm showing us that likely this thing will be here. But what is an absolute support? Well, it's $50. That was absolute support for 45 years. It was a ceiling. So when you have technical setups, okay, on stocks, on anything, they look like, let me get the tool I'm looking for and I'll draw you one. Now my path went away from me when I want it the most. Where did you go, path? Oh, here we go. So let's draw a line here. It's not the best. I should have just done a normal line. Okay, stop that. And what happens on a path, on a resistance, is you come up here with a scenario and you run up and you test it, right? Come down, maybe you go here, come back up and test it, right? Go here, go here, go here, come back up and test it. So we refer to that as knocking on the door. Well, after you knock on the door two or three times, it's just like if you locked a room out and you took your shoulder and you hit the door, you hit it hard, it hurts, you hit it hard again, and you start weakening it, right? To break the wood door strip that's supporting the hole. There's, something, if you hit it hard enough, and it's the same thing here. And so we call this resistance. Well, if you do this over a course of 50 years and you come up to $50 silver, we did it in 1980 and we did it in 2011. And those two times, but guess what? The third time was a magic trick. And we went right through it and we went to 54. And we bounced around and then we took off 60, 70, 80, 90, 100, 120, 121. We got slammed back down to 64, 63.90 an after hour. So to me, that's our big level of support. Could we come down here? Yeah. And we could come down intraday and then get a hammer wick on a candlestick and close back above it, which invalidates the close. So in order to be a real below 50, it'd have to come down, close below it, and get one or two more closes below it to confirm that a whole trend change is in place. I do not expect that. I call it a 90% probability that we go on to 180 to 200 silver in 2026. This will be a slingshot, but it will get a lot of people out. It'll get them out of their miners, it'll get them out of the metal. And don't even get started on these miners. These miners on re-rating alone will go massive. All right, guys, I got one little teaser for some of you guys that, there's enough press out there. Some of you guys have seen it. Certainly, I've talked about it in my Patreon. But it's a stock, a silver miner that's not in production yet that may have the most silver ounces in the world, around 2.6 billion. Now they've got to shore up that from 1.6 to 2.6. And Eric Sprott owns 40% of the thing. He loves it. And guess what? The top silver producing country of the world is Mexico. Well, what did we have? We had cartel issues. It became a hot spot. Normally, North America's pretty darn safe. Yeah, you get up Chile sometimes leaning left, or Brazil, Ecuador, some of them, Peru. But for the most part, Latin America's in order. And Mexico was having cartel issues. I personally think that's a 6-month track. I think we wipe out more of the cartels. I think Mexico gets aggressive with them because that's Mexican royalty revenue when miners go down to Mexico and they mine silver and gold secondarily. They're the largest producer of silver in the world. China's 2, Peru is 3rd. I think Chile is 4th. So Mexico's not going to like that if miners say, well, we're not going to mine there. The geologists go home and their management teams go down. It's Mexican workers that are doing the real labor. So I see that as getting through its issue. But that's knocked them down. It's a little worry point. Well, guys, you don't have that with Hycroft because Hycroft's in Nevada. All right. So I was getting ready to recommend this to my people back at this level when the news was out that Eric Sprott was moving in. A little bit of the story was out. When I looked in the pre-market, it was up 32%. I said, no, thank you. My history of 5 decades in the market, I know what happens when you chase a stock. Now, this was an exceptional stock and still is an exceptional stock. But I've got 20 or 30 others that I think may perform just as well. And I have my Patreons in those. And many of those since August are up massively. And many still have 10 and 20 baggers to go. So what did you get here in this scenario? This was a $3 stock in August. $3 to $60 in 6 months, 7 months. But then what do? When you run like that, you get a retrace. So you go up in wave three, you come down in the A, you bounce in the B. And what do I think? I think this thing's going back between the bottom here. So if we just do a 50% retrace and it's even or par, or there's another name for it, a flat where A, B, C and the A and the C are flat, same, roughly the same level, then you're going back to 30-30. But if we get a little more aggressive with it, could go halfway. You might be 25, 27. I know I'll be buying at 30 cents or $30, guys. I wish I was buying at 30 cents. I imagine somewhere. Oh, no. Okay. So, guys, this setup is phenomenal. Look what else, though. Look at what if. What's another technical thing that can happen? Doesn't have to happen. Most gaps get filled. Not always and not all the time, and sometimes not for many years. This thing could go up into the 500 and at some point in the future fill the gap. That's why they say most gap. But sometimes, is it a possible gap fill? What a buy at 1677. Because stocks can crash without any fundamental change to the stock. There gets fear and oil spikes and the dollar's ripping and it's fear and the world's over. That stock market crash alone, that 20 or 25% that could happen in the S&P, it can take liquidity here. Hycroft was well publicized. You get day traders. When you see something like this, I guarantee you people that don't even know what silver is. They see it on a list. Oh, look at the FOMO. It's GameStop, right? And I'm going to play with it. I'm going to day trade it. I'm on the 5 minute, the 15 minute, right? I'm doing fair value gaps. I'm doing this, RSI. I'm using every technical indicator I can. There'll always be that in markets. But I say to my patrons, know what you own, know where we're going. That, my friends, is the key to success. Think about NVIDIA. Sure, NVIDIA's had an unbelievable run. It would make this not this single move. That's a great single move. But when something's up, 20,000% over 7 or 8 years, how many times did it retrace 50%? People can't handle that. The psychology of a buy and hold investor takes a disciplined person to know what they own. It's easier if you bought here and you went through something like this and the thing rips and it's 300 in 2 years and then it retraces to 150 and your average price is $20, you don't get so fearful of 150. So the longer you stay in and show that discipline, those 50% pullbacks don't hurt you. But these do. Think of all the buyers that were in the FOMO here. How they feeling now? If it drops further, most of them are probably out. So that's what I want you to understand. And that's the kind of stuff I show, I talk about, I tell. I tell through rants, I tell through stories. We have chat groups. This Patreon is about true wealth generation. I know Patreons out there that brag about their members getting 18% and they're beating the S&P. Honestly, if you were in August and you bought the stuff you bought in August, even in a downturn we'll have in March, you're still up 50%. Guys, I've been throwing stuff out in December in the oil sector, another commodity superstar sector. We're up 50 and 60% on big cap names. Some of the little plays, they're up 50% in a day or two because of what's happening with oil. And that's why I'm kind of moving to some trend trading, right? Swing trade. I won't ever go to day trading where I'm posting I'm in at this level and out at that level, but I will post that this is a swing trade. I'm buying it at 30 cents. Anything above 60, I recommend you take profits. 60 cents. And then you play it. If you get it in a day or it takes you 3 days. And then some of these will be long-term holds if they end up going to $2 or $3 and they catch, because I'm only playing it in the sectors that I know will do nothing but go up in this commodity super cycle. I'll never say forever because nothing is forever. I remember back in the late 90s playing the pharma. I was buying all these little names. One day it was stem cells. The next it was heart medications, the next it was genomics stocks. I mean, it just was a constant litany of swing trading, making between 50 and 100% from one day to 4 days. And it just rotated through the pharma world. But you get that and then it's done. People are still doing it later, but it doesn't have the FOMO level, right? Silver will come back. You'll see Wall Street bets, 3.0, because silver's got to run it. My target, I didn't even put it on there. Well, I did. I told you 400 plus. I didn't say it on there. I got 400 plus oil. I got 400 plus silver. I got 15,000 gold. All right, guys, that's what I got for you. If anybody wants to contact me, it'll be in my one, but let me add it just so you have it. Anybody wants to contact me, it's Bruce at 2500. Come on, Bruce, 2500 at gmail.com. And the Patreon is patreon.com/TWC 100. So come join us. There's a free tier. You don't get much. You get these kind of videos, but you're not going to get it. If you want to join that, come in and do the pay portion, and you will get top names. You'll get access to all my videos. It's rare that I do something like this to the public. This is the kind of stuff I do regularly for my people. I vet these because this company's already vetted. This is even in the public domain about people knowing about it, right? But did you know where silver is going? Do you know when silver is going to take off? Do you know? That's the kind of stuff we talk about. I had 25 10 bagger stocks. I just recently added 15 more gold and some silver stocks that are 10 and 20 bagger opportunities, guys. You don't see that every day. So send me an email. Some of you know me on YouTube, have come in, have lost money in the yield losers and the defiance, decliners and other funds. And you're playing dividend only game, which is a losing game unless you know which entities are really running. Okay. I'm putting out a list of 17 more recommendations around the AI data center, from fiber companies to rack plays to, photons and to copper and all the things that are involved in the energy and the building out of AI data centers, which the grid can't support currently. All fits within the energy realm. All right, guys, that's what I got for you. Hope you enjoyed this. It's lengthy. I did a little bit of rantings, but some people will be disappointed it isn't my all-star rant. All right, guys, have a great one. Bye for now.